Welcome to the Income Cycles podcast, the place to discover how to get returns like the professionals as an average person in the property, forex, and crypto markets. And now over to your host, Mark Vernham.
Hello everyone, it's Mark Vernham here and welcome along to this edition of the Income Cycles podcast. It's great to have you here. I hope you had a great week. This week we're going to be talking about is now the right time to buy property, because we are in the middle of yet another turbulent market, let's call it that, in property. We're seeing headlines out there and I'll share some that have caught my eye this week, but ultimately is now a good time to buy property. That's what we're going to look at in the actual debrief segment. We're also going to look at some news that have caught my attention this week in the property, crypto and forex world. And also at the end, we're going to give you a really great income extra resource. So let's dive straight in with this week's news that's caught my attention. So when it comes to property this week, on CNBC, UK house prices are expected to be falling by 10% this year. That was their headline. Basically from Lloyds Bank, the CEO, Charlie Nunn, came out and said that they believe that higher mortgage rates and broader cost of living will basically shorten home buyers, as in there'll be less home buying happening. And basically they've seen kind of around 40% of mortgage products from when the disastrous mini budget happened in the UK, basically kicking in. Took a while for the market to come back, and as a result of that, a lot of people have come out the market. What they do also see is obviously inflation kind of going up. This is from all Lloyds Bank themselves, who are one of the bigger lenders in the market. And what we've also seen here, it says that according to a property website, Rightmove, Monday also showed asking prices for homes rising slightly in January for the first 2 months. Now, this is where you've got to be careful, because, you know, you're seeing on one hand a report saying that a leading economic indicator of the market, i.e. banks and lending, are saying they expect the market to fall 10%. I've also seen markets and reports and various other things out there saying experts in certain areas are seeing it fall 30%. So when you've got all this going on, there's an opportunity here to kind of look at what's going on and understand it. So do I think the market's going to fall this year? Absolutely. Do I think it may be as high as 30% in certain geographical areas? Absolutely. Particularly where there was a very strong appetite in, you know, sort of seaside homes, big country homes, that kind of stuff, where when the pandemic everyone exodused, then, you know, kind of they're now coming back onto the market, or people's appetite for that has certainly demanded and gone less. And as a result of that, you're finding now those sorts of properties are hanging around and asking prices are being reduced. I don't know if you haven't already, get a Rightmove little tip I'll give you. A Rightmove alert set up, sending you kind of property prices for a given area, and it'll ping you when a new one comes in. All I'm seeing right now for the last probably month or so is reduced prices. So, you know, anything that's been reduced, I get an email from Rightmove saying in your area they're looking at these, you know, properties are coming on that are now reduced. I'm seeing reductions of 10, 20, 25% was one I got through the other day. So certainly rural properties are being put back on the market, and there's not much demand for them is the problem, because we're not in a COVID world where everyone wants to live in the country anymore. They want to get back to what I call normal life. So that's interesting. As far as kind of the Rightmove report here saying asking prices rose slightly in January, remember, an asking price is not the same as a sale price. So doesn't matter what the asking prices are doing. You know, it's the final sale price is the thing that counts. So just watch what you read and how that's interpreted, because some people may think we are still in the start of a boom phase, or we are in property growth phase, because, you know, we're in this cycle, which I'll come on to in the debrief, which is the 18-year property cycle that's coming up soon in today's debrief. And we're going to basically analyse that, but kind of like, yeah, watch what headlines, and also kind of watch how they're interpreted and back it up with your own research and your own data. Okay. So over to the FX markets, and a statement out of Reuters from the governor of the Bank of England said there could be, I love this one, could be a rapid fall in inflation in Britain amid global energy prices dropping over the last few weeks. But this is always the Bank of England like to do a but warned that shortage of workers and strikes and cost of living could all undo that, and it won't fall down as quick. I don't know if you listened last week to my podcast, but I talked about inflation a lot there. We did a whole debrief segment on there, and how basically the last time we got into double-digit inflation, it took 6 years to come back down. So I think the governor of Bank of England, good old Andrew Bailey's there, is kind of playing both sides by saying, on one hand, it might drop sharply, which is a good attention-grabbing bit because everyone wants inflation to go down. Well, not everyone, but most people do. Certainly the average man in the street does, governments don't. But ultimately, as a result of that, then basically what he's seeing is that, but yes, it could go down a lot this year because oil prices now are going down. Now, we will be doing a future segment on a debrief on oil prices because they do affect not just sort of FX rates and business rates and various things going on and share prices and FTSE 100 and US 30, but they also affect a lot of other things now. They also affect kind of property prices. They affect lending. They affect everything because people's money is being squeezed from all angles now. So it's not just a tax that's been introduced, let's say, that squeezes people's money. It's cost of living. It's cost of moving around. It's all these things, but also it affects everything they buy and how much they buy because oil prices are high or low depending on what's going on. That's supply and demand. Okay, so watch this space. We'll be doing a future debrief on oil prices and why they're so important and why you should be paying attention to them. Not just for how much it costs to fill up your car, but just kind of like where you're making investments. You've got to be looking at what the oil price may do to that particular asset or that particular way of making money, because it is really, really more prevalent now than ever. Along with inflation, they're both very, very powerful tools that move asset classes and economies very quickly. So, basically he's saying the war in Ukraine is the thing that's keeping inflation high. And as soon as oil prices come back down, then we won't have any problems anymore. And they're coming down. So, technically inflation could drop a lot. Well, I will say in future episodes, we'll cover why, the whole war in Ukraine, whilst it is a tragedy from a human sense, actually when it comes to oil prices is not the real reason. Oil prices spiked up. And at the moment, I believe due to kind of people cutting back on journeys and various other things and manufacturing slowing down, there is less price for oil, less demand for oil. So therefore prices are going to be cheap. But watch this space because I will show you and declare to you how I believe they're going to go up quite considerably in the next year or two. So that's if you're in the FX, watch what's going on there. That's all going to affect your pounds, your dollars, your US 30s, all those sort of things that you might be trading there. And moving on to crypto from Bloomberg this week, more dodgy news for crypto firms as basically yet another kind of company has been affected by the good old FTX bankruptcy, and also now a company called crypto giant Binance admitted to processing 346 million in Bitcoin to the Blitzato digital currency exchange, who founder was arrested in the US last week for allegedly running a money laundering engine. So basically kind of, yet more kind of bad news for the crypto people out there. And you could argue this may well be engineered because we've had obviously the FTX bankrupts happening there and what went on there. We've had Gemini go, we've had Genesis froze up and kind of declaring themselves bankrupt and lack of liquidity from what's going on there. Everyone likes a bad news sells, and when it comes to crypto, bad news really does sell. However, crypto, Bitcoin itself is actually up from sort of $18,000 to $23,000 from early Jan. So, seeing bad news sells and push the asset price up. Do I think it will get back to the heydays? Well, again, there'll be an upcoming episode on crypto, Bitcoin specifically, but also check out the fundamental series that we do on the podcast here, where we basically go through one of the foundations of what we believe and what we look at and what I look at. We've got one on crypto, which kind of looks at the whole market and what the cycle is there and where we're at in there. So keep an eye out for that in your feed. Okay, so let's now get on to this week's income cycles debrief, and quite a big topic, and I think obviously, firstly, you may have heard of what we're going to talk about. It's called the 18-year property cycle. You may not have. If it's brand new to you, then I highly recommend checking out the Income Cycles Foundation, Understanding and Profiting from the 18-Year Property Cycle, podcast that we've done. You'll check that out. That's in your feed if you are following us. If you haven't already, then make sure you subscribe to that to get that completely free of charge. Subscribe on any of the platforms that you want. But we're going to talk about the 18-year property cycle and where we're at. And let's really look at this, because if you understand what the property cycle is and you also get a rough idea of where you're at, then you can benefit from it or not benefit. And there may be some decisions you're looking to do with property, whether it be your own property or investment properties out there, that you might want to be aware of this to take it into your decision-making process. That's really the key thing. nobody, and let me tell you, nobody, not even the best people in the world, can, with all the information in the world, can predict what a market is going to do, whether it be, a financial market, a property market, or whatever. You can have indicators, you can have guides, but no one can time the market. And getting the timing of these things is impossible. So don't try and time it. Just be aware of where you're at in a rough cycle. That's how I've made my money. That's how I suggest anyone looks at this and looks at everything they do when it comes to investment, because it's like planting seeds in winter and expecting them to flower within a month or two. It's just not going to happen because the ground isn't warm enough. So you wouldn't expect seeds to flower in January, let's say. So if you're getting into the property cycle at the wrong time and expecting it to make money when it's in a downtime, well, then you're going to be disappointed. Doesn't mean the asset doesn't work or the class or the cycle doesn't work. You just got to be aware you're entering it approximately, and it's not going to be a definite point. Okay, so covering the 18-year property cycle in this week's debrief is really, really key. So where we're at with this, we'll come on to in a second, but let me just kind of summarize so you don't know what the 18-year property cycle is. So essentially, it's become about by a gentleman called Fred Harrison, who's a US economist that tracked property data over many, 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 many years and looked at the supply and demand of such cycles and prices in property and saw a pattern, because most industries, markets, etc., everything has a pattern. And funny enough, I'm actually in the process right now of writing a book about cycles and income cycles and patterns within those cycles. And as a result of that, there's a pattern emerged, and that pattern was every 18 years. There is a cycle that property typically goes through. Now, is it specifically 18 years to the day? No. Sometimes it's less, sometimes it's more, but this cycle has repeated itself in some way, shape or form approximately every 18 years since kind of, real estate or property came about and was kind of an asset class that people bought and sold. So if you understand this, it's about understanding approximately where we're at in that cycle. Now like where we are in the cycle, is it a good time for you to do what you wanted to do? So if you wanted to buy property, is it a good time based on approximately where we are in the cycle, based on data of where it's gone before and what it's done? What are your expectations and what your timeline is? In certain parts of the cycle, you won't profit because there's no profit in that market. There's no profit in that type of cycle. If we buy another type of area of the cycle, phase of the cycle, you're going to get more profit. Okay, so it's just being aware of this. You can't time it. It's virtually impossible to time it. If you do, it's more luck than judgment. So it's all about supply and demand. That's really the key thing. And this is no different to any other cycle that I've analysed in both crypto, in forex markets or anything like that, or in businesses just generally. There is a cycle and it's all about supply and demand. And when there is less supply, of course, the price goes up. We all know we've been in lockdown. We had been for a previous few years back, where wood prices just went crazy. You couldn't get exercise equipment. I remember looking to try and buy some weights so I could work out at home, and they were like treble the price, even if you could get them at all. So that was because there was a real constraint on supply. So as a result, demand went up, prices went up, and that's what happened. But now, obviously, the world reopened and we can now buy weights again. Their prices are normalised. So it's a cycle that goes round. This is no different with property. So what is the 18-year property cycle? What phases are there? Well, there's 3 phases. The first one is year 1 to 7. Okay, year 1 to 7. So imagine just a very simple 1 to 18 graph kind of line. Years 1 to 7. This is where it starts what we call the recovery phase. Okay, and this is where kind of you'll see at the end of the cycle, something happens that causes a recovery phase to happen. And this is really kind of where the market is just like recovering, as it says, from this problem that's happened. And ultimately, everyone's warned off buying property because it's a danger, it's a problem, it's this. We've recovered from a shock. Now, the last one, obviously, was kind of after the 2008 issue where there was all the 110% mortgages, people going bust, banks going under, etc., other banks being bought out, other banks being nationalised or sold off or whatever, bad debt everywhere, etc. Obviously, people overexerted themselves when it came to buying property and bought multiple properties, self-certification, etc. And as a result of that, everyone got into the market, and then suddenly the market contracted, the supply was there, but the demand contracted, and as a result, the prices dropped. So therefore, once that happens, there's a recovery phase. So what then happens is the masses, let's call it that, the masses of people don't enter the market in recovery phase because they've just been burnt. It's like putting your hand over a fire. You get burnt, you pull your hand back, okay? That's kind of the recovery phase. And basically, when you're in recovery phase, this is where the brave people come out, kind of, the smart money, as it's known, come out because they understand that when you're in recovery phases, typically prices are lower because people either need to desperately sell because they've overstretched, or there's a bank repossession going on, or whatever it may be, or just generally the banks want to get rid of their oversupply because they got greedy, etc. And it happens, believe it or not, where they're overextended and they've now got to sell back this portfolio and get rid of it, etc. So in the recovery phase, if you are what I call brave and have available capital, then you can go out and buy property very, very cheaply because ultimately nobody else wants to buy it. Okay, so it's kind of, this is like, if you're going into a supermarket and you're willing to buy the food that's got a little yellow sticker on it saying it's going out of date today, you're going to get a real discount because no one wants to buy that food because they know they've only got a shelf life of a few hours typically with it. So that's kind of really what this is. It's like you're in recovery phase. If you have capital available, you can get a bit of a deal, but you've got to be in a position to understand that you can't necessarily easily get finance. Not say you won't, but you may struggle to get sort of regular finance in the rest of the property cycle. And that can last for 7 years to recover. So, like a lot of the cycles, like a lot of things, inflation and things like that, all these things obviously affect the property market. But, 7 years it can take to undo a very short period of problems that have caused in a short period. It takes a long while to unwind. So that's the key thing, the time it takes from there. Now, typically during that 1 to 7 year recovery phase, you'll find people getting into the market who are speculating and being able to kind of go, yes, I can see an opportunity here, buying property. And then what some of them will do is cash out. They'll mid-cycle, somewhere in the sort of 5 to 7 year bracket, they'll come back out. And suddenly the market will dip again. So if you just keep it really, really simple, I'm looking to buy a house, let's say it's a £100,000 house, and it's on a street, and I'm looking at this cycle, whether or not I should buy it. If it's gone down in value, it's in recovery phase, and it's starting to really kind of ebb and flow down. As soon as that price starts to move up, and suddenly it gets bought, and then comes back on the market maybe 3 months later or 6 months later, being refurbed or whatever, and someone's cashed out, well, now you're in this mid-cycle dip. So basically what it means is people entering the market, kind of got the cash there, they're going to go off and go, right, I'm going to cash in now whilst the market is kind of giving me enough return. I'm not going to get greedy, but I'm now going to mid-cycle year 5 to 7 approximately take my money back out of the market, and that of course causes it to dip again because the masses haven't kind of caught on yet that the market is ready to restart again. Okay, so that's years 1 to 7, but you will see a dip around 5 to 7 where you kind of have this mid-cycle dip where people take their early profits. Phase 2 is the 7 to 14 years, which is kind of explosion or expansion, whatever you want to call it. And you'll probably start to see kind of like the masses start talking about this. And this is where kind of certainly in year 7 onwards, but as you get nearer that year 14, you'll find that, like as we enter year 14, suddenly everyone wants to buy property. Everyone is like, oh, I've got to buy property now. But at year 7, they're just starting to understand and go, oh, okay, yeah, I think property prices might move up a bit. So, I've looked and I've seen things moving. I've seen more cranes appearing locally. I've seen more stuff happening locally. I've seen more, maybe cafes or whatever open, or I've seen like a new development start down the road and stuff like that. I'm seeing things happen. That's the early sort of roots now coming through of new growth. Okay, so again, if it's like planting flowers and planting bulbs in winter and expecting them to flower, we're now into springtime and it's just early spring and they're just starting to pop up. Well, that's then when obviously you go, okay, now I'm getting that return. So you'll see this, and as it goes from years 7 to 14, you'll start to see crazy stuff happening. You'll start to see people talking more in family or friend or pub type environments, I call it. As soon as someone's talking about something in the pub, that's when you're too late to the market, because if the average person is talking about it, that's kind of the end of the cycle almost. It's about to crash. And, we know with Bitcoin and all these other crypto stuff and all these great tip-offs, my mate down the pub's bought crypto, suddenly, this coin or whatever, or Bitcoin, and it dives. Well, that's why, because kind of like the masses have got into it. So certainly during this like explosion phase, depending on how early you're in on it, then essentially there may be profit or there may not be profit. Because if you're getting to the point where you're in the last couple of years is what we call, or Fred Harrison, who wrote the book, and came up with this, is kind of what he calls the winner's curse. And the winner's curse kind of happens in the last 2 years of this cycle. And this is where people enter the market who are, I would argue, fairly uneducated, don't understand the stuff that you're listening to now, not really done any research, but they've kind of been told by their friend or the estate agent or whatever, great time to buy now, buy now, buy now. Don't do any research, and they just believe that the market's going to keep going up and up and up and up and up and up and up. Okay, and this was very true during kind of COVID, where like, oh, buy a house, you can't lose. Buy it by the seaside and rent it out for Airbnb, you can't lose. And it's kind of like this is kind of like what I call a winner's curse. People go into these things without even knowing, without doing research. They just got caught up in all the excitement and all the market headlines, and you start things happening where you start seeing headlines on things like house prices increasing by £200 a day, because suddenly it's like, oh my god, there's so much money to be made in property, let's all pile into property. So as a result of that, that's what you find. You get this kind of euphoric environment where nothing can go wrong. It's like the winner's curse, I'm always going to make money. And then you also get crazy big projects come out with like the tallest building in the world or the biggest shopping centre or whatever it may be. Like you get these big sort of vanity projects that are doomed to either fail or not complete because they've been built at a time where there's just so much easy money around that people think, oh, it's going to be so easy forever, we're always going to make money. And that's what I call the explosion phase. Now, you can make money in that phase, but like I say, if you're trying to get in when the winner's curse part's in, you're going to be paying the most. And depending on your timing of when you want to get that money back out again, you may end up losing money. If you hold it, property always will kind of generally go up as a consistency, about every 8 years or so. It's going to go up, okay? So that's going to double effectively every 8 or so years, right? But if you sell it at the wrong time, like the only time you lose money in property or in any investment is when you sell it. If you sell it at the wrong time, you're going to lose money. If you sell it at the right time, you're going to make money. So just be aware when you're entering the market, particularly the property market, roughly, where is it in this cycle? Are we in the recovery, explosion, or the third phase I'm going to come on to in a second? But within those segments, where are we? If we're in the latter stage of the explosion, it's going to be expensive, and you may or may not realise a profit if you're looking to get out within a couple of years. If you're holding it for 20 years, well, that's very different because it's going to go through a new cycle. Okay, so just be aware of that. Then, from years 14 to 18, the final third part of the phase is the recession phase, and this is where basically the whole thing kind of, we use words like bubble and it blows up and all these kind of wonderful terms, but it's basically built not on actual supply and demand curve. It's kind of gone too much the wrong way, i.e. people just think it's going to keep going forever, and ultimately it's all built on sentiment. Suddenly you start seeing newspaper headlines saying property prices falling, property prices will go down by 30%. Just earlier on in this podcast, the Lloyds Bank CEO has come out and said, it's going to go down 10%. We're starting to see this, okay? So you could argue we're starting to enter the recession phase, but this is where you can't call it exactly, because there could be another 2 years of growth before we see that. We've certainly not seen a big explosion. We've seen it a bit with obviously kind of what's going on. I'll come on to where we are now in a second, but ultimately it all just is built on sentiment. Newspaper headlines start talking about property prices. People who are over leveraging start to get their loans called in because they can't afford the mortgages. They're not renting them out as quick, etc. They end up waves of false selling, which pushes prices down even further. And then the pattern basically at this point is, importantly, with all these cycles, okay, recession, explosion or expansion, and recovery, all those three cycles, it's just going to go back round again. So once we hit that recession, we're then going to go back into recovery for 7 years or so. Then we're going to go for 7 years of explosion, and then we're going to go for another 4 years of recession. So when this happens, there's a pattern, and the pattern is, importantly, when each cycle starts from a higher bottom or a lower low, so higher than the previous end. So if you look at a house price in the street, if that house price in recovery phase has gone from 100,000 up to 110, it's then exploded in the next year from 110 to 150, each part is now going to follow a higher version than the next one, okay? So when recession kicks in, it's now got to be back down to kind of above the 110, because that's when that expansion phase picked in, okay? So the key thing here is that you always got to remember, it's the long-term trend is always upwards, even though there's lots of volatility along the way, lots of changes, lots of headlines, lots of this, lots of that. But the key thing is that it's always going to evolve each time it goes through a cycle, okay? So that's the important thing to know. It's always going to be higher bottoms than the previous one. So just remember that when you're looking at property prices, more importantly, property asking prices, like I mentioned earlier, just because they're asking for a higher price, do your research. Look at, what the actual houses were sold for locally. Are they more or less than the asking prices out there? Because what's been sold, and you can check this on land registry sites, etc. What's been sold and what's been asked price are very different. Okay, very, very different in a lot of cases. So there are three phases. You've got recovery, explosion or expansion, and recession. Okay, and that's your 18-year cycle. It just keeps going round and round and round. Like I say, no one can call it specifically. Where we're at right now is year 17, year 15, year 12, year 3, year 5. You're somewhere on that timeline. Okay. And the last time round, to say, this kind of stuff happened, we saw obviously the recovery phase after the banking stuff blew up in 2008. You could argue we've seen some expressions of the explosion phase, etc. And then we've not quite entered the recession phase. But let's look at where we are right now, because I think we're somewhere between the explosion and the recession phase, because we're seeing new builds slow down. In COVID and all that kind of stuff, prices during COVID and stuff, prices spiked, and you were getting more and more prices happening, bigger prices happening, closed bids, open house, that kind of stuff, all that craziness. And now we're starting to see markets slow down. There's certainly lots of headlines I've seen kind of show that, in that house prices are dropping. Certainly housing prices are dropping. What the asking prices are, like I mentioned earlier with the Rightmove thing coming through, consistently property prices are starting to drop. Now, how much they drop, who knows? Somewhere between 10 and 30%, depending on what the analysts are saying. I think, certain pockets that grew a lot in COVID, in that expansion phase, will drop. They'll correct back. Okay, they'll correct back to maybe a 5% growth over that period rather than a 30 or 35% growth. There's areas in like Cardiff, for argument's sake, was one that grew 35% last year according to Rightmove, which is crazy. That's going to correct back as an example. It's not to say Cardiff is a bad place to invest, but if you're looking to realise a return pretty quick, that may not be the best place for you to look at right now. So do your due diligence, look at the areas, etc. Do the research. So I think we're somewhere between kind of explosion and recession. I think we're kind of just teetering on the edge of that recession side, because new builds are slow, house prices are locally falling. We're not seeing it across all areas, but it's starting to. Like I say, it's not gone national yet, if that makes sense. We've not seen a widespread for sale boards going up everywhere. We've also not really seen kind of the whole repossession-y type overextension thing kick in, although we've got cost of living happening right now. We're in winter, oil prices are higher. That's going to come off in the UK in March, so that may have an effect on people being able to pay their mortgages as their bill increases on their energy, no matter how much they cut back. Do you know what I mean? So we've got lots of things still in play that haven't quite kicked in on the finance side to say, yes, we're in this recession phase now. So, ultimately what you want to do is look at where your money is and what you're doing. And if you do want to really benefit from that recovery phase, then get yourself set up now. Think about that. Think about, well, okay, we've got, years 14 to 18 is the recession. So we could have 3-4 years of market prices going down, and kind of it gets worse before it gets better. If I'm thinking of buying in the next year, am I better off waiting for another year? Because 2 years down the line, it will be worse. Do you know what I mean? And then it will pick up from there. Now, again, there is no magic formula. I can't tell you we're in year 14 specifically right now. We can only get an indicator. We can go, we're somewhere around that sort of phase. So we think we're between years, I would say we're sort of year 13 to 18 in a generic sense. In a calendar sense, we should definitely be in recession, so to speak. But I don't think it's quite kicked in yet. So always look at where your money is, what you're doing with it. Is it safe? Is it good to go and buy a property now? Well, it might be, depending on what your actual timelines are. How much you want to realise out that investment. Are you looking to rent it? Are you looking to buy and rent it out and profit from it for the next 10, 15, 20 years? Or are you looking to buy and flip and refurb and make money that way? Depending on what you're doing, you've got to realise where you're at. Because if you're looking to buy and flip and refurb now, you're going to be buying at a higher price and the market's going to go down. So if you're going to try and refurb it and then remortgage it, or refurb it and then sell it, you might find you're now into the recession phase by the time you do that, and you just can't sell it because there's no demand for it. So would you be better off waiting a bit and actually kind of getting into the market later when prices are cheaper, and you can take a bit longer and use your own money to do it up and then go and sell it at a profit without having to remortgage, whatever. It's all down to you as your personal circumstances. But the key thing is to just think about what you're trying to achieve, where you're trying to achieve it, and what the cycle of property is doing in this 18-year property cycle. So that's really the key thing. Don't always assume that rents are going to be high, because cost of living is going to have an effect on rents. Rents can't keep going up because ultimately people can't afford it, because wages can't keep going up because businesses can't afford to keep paying them. Because they keep paying that, then it's going to have a knock-on effect on prices. Prices will get too expensive, people won't buy, businesses go under, people make their jobs redundant. Now they can't afford to pay their rent or their mortgage. So I think, this is where that recession part really starts to kick in. So be aware of where you are in the cycle. There's not a definite. Think about that. Think about where your money is. Could you put it in other places that's going to give you more return quicker than property? Investment funds, let's say, that give you 7% a month or something like that, or 2% a month, that can build rapid money by compounding down, and then you can come into the market in the recession phase or recovery phase to actually then take property really cheaply without having to mortgage, because then you're in a cash buyer position. That's opportunities there. So just think about those kind of things. They're all out there. Do your research. Listen to this podcast. We'll tell you all the various things and more about how to access those sorts of investments. So think about what you're doing. Think about where you're going to go from there and what you're going to do to ensure you're entering the cycle based on what you want to achieve, that you're entering the cycle at the right time to benefit from it and don't get caught. So that's a short summary. We went a little bit longer this week. Short summary on the 18-year property cycle and where I believe we're at. I do have a property cycle income foundations report about the 18-year cycle. That is on the foundations course, which you'll find in your feed of this. If you haven't already subscribed, you'll get access to that just by following the podcast. You'll see all the programs that we've got out there and all the ones that we've done in the past. And that's really, go check that out if you want to learn more about the 18-year property cycle. We've got a whole Cycles Foundation podcast on that one. So this week's income extra resource. Now, it would be silly of me not to give you another resource about property cycles and property, because that's all we spoke about on this week's edition. So I'm going to give you arguably the best resource for this, which is a book called Boom Bust, and it's by Fred Harrison, the guy that came up with the 18-year property cycle. Very statistical, very analytical. So if you're not that type of person, don't buy it. But I certainly recommend, if you are interested in learning more about the property cycle from the man who came up with the whole thing himself, then get that book. You can get it off Amazon, eBay, etc., because it's a real great read. So if you're interested in that, pick up a copy of that, give it a read. You'll thank yourself for doing it if you are interested in property. It really is very, very valuable and goes even deeper than what we've covered here and what we've also covered on the foundation audio course that we put out there on the podcast. So I hope you've enjoyed this week's podcast and episode and show and enjoyed it. And I look forward to seeing you on a future one next week. And remember, your money should be working even if you're not. And you need to make your money work as hard as you did to get it. I look forward to seeing you on next week's podcast. Take care. I'll see you next week.
That concludes this edition of Income Cycles. Be sure to tune in each week to hear the best information on how to get income like the professionals do from property, forex and crypto markets. For more information, please register your free account at incomecycles.com. Once registered, you'll receive our free weekly research roundup email containing links to the very best free trainings, webinars, and guides to making an income like the pros do from markets. If you haven't already, you can subscribe to Income Cycles on iTunes, Spotify, or your podcast platform of choice to have Income Cycles automatically delivered to your mobile device each week, free of charge. You can email questions for the program to ask at incomecycles.com, and we'll answer your questions on the air from time to time in our Ask Us segment. Income Cycles is presented for informational and entertainment purposes only. The information presented on Income Cycles should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Income Cycles are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Income Cycles, its producers, sponsors, and host Mark Vernham shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Income Cycles. If you enjoy listening to Income Cycles, why not share it with a friend or colleague? We thank you for your support.